There are three companies from different sectors, all benefiting from the AI boom that could potentially transform your investment portfolio. And no, this isn't about luck or a get-rich-quick scheme. It's about smart, calculated moves in the world of growth stocks. And I bet you have never heard of at least one of these stocks. Felix here and my trusted research assistant, Taluda, and we're going to dive deep into our three top growth stocks that could potentially make you wealthy without relying on chance or luck or any of that. And as I said, my faithful companion Taluda here has been eagerly sniffing out the research, and the data is really quite intriguing. Now, you might be thinking, Felix, what makes these picks so special? Well, that's precisely what we'll explore here in the next few minutes. We'll dissect each company's business model, market position, and future prospects. Plus, I'll share insights from Talluda's experience as a former investment banker to give you a comprehensive view, won't you, Talluda? She's purring. All right, so let's get cracking. Now, in addition to being a great researcher, this one's also a great trader. Her portfolio is up over 80% so far this year alone. That's our teaching portfolio, of course. So we've turned $30,000 into $54,000 so far this year. If you're keen to learn our strategies, then you are in luck. We're hosting a beginner trading training this coming week. Just go down below. Link is down in the description. Is the first one you'll see. And you get to learn our entire system, our entire structure, completely for free. But let's get back to the main story. Are you ready to discover these potential game changers? Well, let's begin with our first contender. And yes, you've heard about this one before from me, SoFi. Imagine a financial Swiss Army knife that cuts into the traditional banks industry, and that is essentially what SoFi has become in the fintech world. SoFi started as a student loan refinancing company in 2011, but they have grown. They now identify themselves as no longer that student loan business. It's a one-stop shop for an array of financial services. We're talking personal loans, mortgages, credit cards, cryptocurrency trading, the whole lot. It's like they've taken the entire high street of financial services and shrunk it down to fit into your pocket. But what truly sets SoFi apart is its integrated approach. They're not just offering one standalone product, they created an ecosystem. Their mobile app services essentially as a financial hub. So it allows you to borrow, save, spend, invest, protect your money all in one place. And that is rather unique. In addition, they own the backend. So they actually own and build and charge other fintech companies, other digital banks to use their backend, which is pretty impressive. Now, what about market position? Well, as of 2024, SoFi boasts a whopping 8.8 million clients and 158 million platform accounts. That's more than the entire population of, London. This rapid growth has positioned SoFi as a formidable player in the fintech space. But here is where it gets particularly interesting. SoFi isn't just serving retail customers. As I mentioned, their technology platform, Galileo, provides services to other financial institutions as well. It's a bit like being both the player and the referee in the financial game. It's a unique position that diversifies their revenue stream and strengthens their market foothold. Now onto the juicy bit. Growth potential and prospect. SoFi's recent financial results paint a rather rosy picture. In Q2, they reported a 22% increase in revenue. And that's the kind of growth that makes us growth investors excited, right? But it's not just about numbers. SoFi's continuously expanding product offerings and growing user base suggest there's still a lot of room for expansion. Their tech platform and financial services segment showed a combined revenue growth of 46% in the last quarter compared to a year before. That's like a rocket taking off, and we might just be at the initial stages of liftoff, if you believe the CEO. Of course, as with any investment, it's not all sunshine, but the fintech sector does have a lot of competition. SoFi will need to continue to innovate to maintain its edge. But I like their comprehensive approach. I like their strong growth from the technology platform. And they are actually using AI in a smart way. They're using it to sell stuff to you. When you log into the app, it'll now suggest services to you that you haven't used yet based on your performance or your usage of the platform, because they know what you're investing, where you're spending, you have a credit card with them, and so on. So they're using AI to cross-sell even harder than they already are, and they're already brilliant at that. Now, what about profitability? Many fintech companies are not profitable. SoFi achieved GAAP profitability for the third consecutive quarter. Net income was 17 million. That's pretty impressive. And yes, it's early stages. It's like a child taking its first step. Exciting, but there is obviously still a long way to go. But I like that. I think growth companies are in their sweet spot when they've just turned profitable. That is when Wall Street starts to pay attention. Well, what about the stock performance? Well, as I'm recording this, SoFi stock is around $7.50 or something like that. And that doesn't sound terribly impressive. And you're right. The stock's down about 20% year to date. It's a bit like expecting a gourmet meal and getting served beans on toast. I actually rather like beans on toast, but maybe not what you were expecting. But remember, growth investing is a marathon. It isn't a sprint. SoFi's smaller market cap of about 8 billion suggests it's still in the early growth phase. Think of it as a promising young athlete. Lots of potential, but still needs to prove itself on the big stage. But let's look at some other metrics that have caught my eye. SoFi boasts a gross profit margin of 82%. That's like squeezing every last drop out of a lemon. Quite impressive. And their 5-year revenue compound annual growth rate is 50%. That's also insanely wonderful. Looking ahead, SoFi's management has raised their guidance for the year, showing confidence in continued growth, which is pretty good considering that we're a little bit worried about the US consumer and so on. But Wall Street's still a skeptic on the stock. Why? Well, for one, they're a direct competitor to the very banks that would normally give you stellar analyst ratings. Why would they do that? And at the same time, we're coming out of a period of high interest rates. When interest rates are high, everybody hates fintech. Every single fintech stock out there has underperformed the last few years. I think there is a good chance here that that might turn around. So in my opinion, SoFi presents an intriguing opportunity, showing strong growth potential, diverse product offering, expanding user base. But of course, there is a risk with everything, especially with growth stocks. So do your own bloody research and don't rely on me entirely, or Taluda for that matter. But let's turn our attention to our second stock. And actually, it's the third one that you've definitely never heard of. Our second stock is Shopify, a company that's been building quite the empire in the e-commerce world. Imagine, if you will, a massive construction site where businesses of all sizes are erecting their digital forefronts. That's essentially what Shopify has created. At its core, Shopify is an e-commerce platform that provides the tools for businesses to sell their stuff online and in person. It's rather like a one-stop shop for budding entrepreneurs and established corporations. Their subscription-based model offers everything from website creation tools to payment processing and shipping solutions. But Shopify isn't content with just providing the foundation. They've expanded their offerings to include a robust point-of-sale system for brick-and-mortar shops, a payment processing service called Shopify Payments, and even a fulfillment network to handle the logistics of shipping products. It's as if they're not just providing the brick and mortar, but also the shop fittings, the till, and even the delivery van. Now let's talk about their market position. As of 2024, Shopify holds a whopping 32% of the US e-commerce platform market share. 32%. That's not just a slice of the pie, it's nearly a third of the entire bakery. They're used by merchants in over 175 countries with more than 2.1 million daily active users. To put that into perspective, that's more than the population of Paris logging in every day to manage their croissant online shops. But what truly sets Shopify apart is versatility, serving businesses from the smallest startup selling homemade jam to large enterprises moving millions of dollars in merchandise a day. And this adaptability, combined with a user-friendly interface, a great app ecosystem, gives them a significant edge in a fiercely competitive market. Looking towards the future, Shopify's growth potential, in my opinion, is rather exciting. The global e-commerce market is expected to reach a staggering 8.1 trillion by 2026. That's like discovering a new gold rush, and Shopify is selling the most reliable pickaxes and shovels. They focus on international expansion, and the burgeoning B2B e-commerce sector could open up new avenues for growth. Moreover, Shopify's commitment to integrating emerging technologies like AI and augmented reality into their platform suggests they're not just keeping up with the times, they're actually shaping the future of online retail. Of course, with great potential come great challenges, and the e-commerce landscape is ever changing, and they're going to need to continue to innovate to maintain that leading position. Now, I say the word innovate rather generously. I actually think they're copying very, very well what the best Chinese e-commerce platforms have done, because they've been ahead of technology. It's a little bit like X is copying WeChat. These guys are copying all the cool stuff that PDD, Meituan, Alibaba, and so on are rolling out in China. And it's a smart move because they have some really, really good ideas. And the only one I see rolling that stuff out is Shopify. And they have a track record of doing this now. They're adapting, they're growing, they seem very well equipped to thrive in the future. But let's dig into their financials, shall we? In the second quarter, revenue grew by 21% year over year, 1.7 billion in revenue. That's pretty amazing growth. And at the same time, their free cash flow margin more than doubled to 16% in the same quarter. So this tree isn't just growing taller, but it's also producing more fruit. And if I look at the balance sheet, they're sitting on a rather comfortable cushion of $5 billion in cash, which is quite the war chest. So they have ample resources for future investments, maybe some little mergers or takeovers of technology or buybacks. But let's talk about some of the other key financial metrics that have caught my eye. They have a solid gross profit margin of 51%, which is pretty impressive for the sector. And their revenue has been growing over the last 5 years at a compound annual growth rate of 45%, almost as good as SoFi, but it's a bigger business. So it's still very, very extraordinary. And guess what? Shopify's stock performance has been relatively flat year to date, hovering around $74 as I'm recording this. It's a bit like a ship in very calm waters, steady, but not making any real progress. The company's high PE ratio of 75 suggests that investors have lofty expectations for future growth. Now, while this indicates confidence in Shopify's potential, it also means the company needs to continue to deliver stellar results to justify its valuation. For the moment, Shopify seems to be focusing on expanding its enterprise-level offerings through Shopify Plus and investing in new technology to maintain their competitive edge. So in conclusion, I think Shopify represents a compelling case for growth-oriented investors. Their strong financial performance, coupled with their market-leading position, focus on innovation, positions them rather well for success. They've also got plenty of cash. However, like any investment, it's not without risk. The key will be their ability to maintain this growth trajectory while fending off pesky little competitors in an increasingly crowded e-commerce landscape. So, of course, not financial advice. Do your own bleeding research. Let's turn our attention to a company that might be unfamiliar to probably you. But one that's been quietly revolutionizing the world of surgery. I'm talking about Intuitive Surgical, or ticker symbol ISRG. Imagine a world where surgeons have superhuman precision and patients recover faster than ever before. That's the world Intuitive Surgical is helping to create. At its core, Intuitive Surgical is a biotech company that specializes in robotic-assisted, minimally invasive surgery. Their flagship product is the Da Vinci surgical system. It's like giving surgeons an extra set of steady, precise hands. It's not replacing surgeons, but rather enhancing their capabilities. The latest data I could find, which is about 2 or 3 years old, they had about 7,000 of these surgical systems globally. And that's more robots than you'd find in most, sci-fi films. But it's not about robots. They also provide the instruments, the accessories, and the services that keep these systems running smoothly. Think recurring revenue. So it's rather like selling the race car and the pit crew at the same time. Let's talk about their market positioning. They're not just a player in the medical technology sector. They're part of both the NASDAQ 100 and the S&P 500 indices. And they've recently made their debut into the Fortune 500. It's like they've won the triple crown of business success. But here is where it gets actually really exciting. Intuitive Surgical has a significant competitive advantage due to their innovative tech and first mover status in robotic-assisted surgery. It's a bit like being the first to invent the automobile in a world of the horse-drawn carriage. The barriers to entry in this field are high, and that gives Intuitive a rather comfortable lead over potential competitors. Their growth potential is pretty exciting. In Q2, they reported a 14% increase in revenue, a 16% growth in procedures year over year. But the global shift towards minimally invasive surgical procedures is expected to continue, and Intuitive is perfectly positioned to ride this wave. It's like they're surfing on a tsunami of medical advancement. Maybe I shouldn't use the tsunami analogy, probably not that. Probably a little offensive. Anyway, we'll move on. Now, you might be wondering, Felix, how does AI really fit into all of this? Well, I'm glad you thought that. The potential for AI integration into robotic surgery is enormous. Imagine a system that not only assists surgeons, but also learns from every procedure, constantly improving its precision and efficiency. It's like having a surgical assistant with the collective experience of thousands of the world's best surgeons. And you might think, well, isn't the future just robots doing the surgery completely? Probably. But I like companies that do something that they can monetize now. So the robot assisted, the AI assisted is, I think, where the money is to be made right now, because if you can say to a surgeon, hey, I can make you 25% better, he's not going to say no, right? And I've got actually one of my students is a spinal surgeon. He was telling me that they now have all this technology where you can look into the body like 3D. So you can see the scans, you can peel back what you're doing. So before you make the first cut, the first incision, you know exactly what's underneath it. If you combine that with the precision of robotics, I think this field is going to absolutely blow up. Now, of course, the medical technology sector is highly regulated, and any hiccups in product development or approval processes and so on could impact growth. But with their strong market position and focus on innovation and the money to actually obtain these permissions, I think they're in a pretty good position. So talking about money, let's talk about their financial performance. In Q2, they reported their non-GAAP income from operations increasing to 754 million, up from 618 million the year before. That's a 22% boost, which is pretty impressive. And the real showstopper was their GAAP income. It surged to $524 million, up from $420 million. And that's the kind of growth that we would like to see. But let's take a look at some of the financial metrics they have. They have a robust gross profit margin of 66%, which implies it's a pretty good moat. And their revenue has been growing at 13.8% on a compound annual basis over the last 5 years, which is nice and consistent, steady growth, which is exactly what we like to see. Stock price is, as I'm recording this, around $480, which is 45% up year to date. The market cap is now 171 billion, which is, again, not exactly a teeny tiny company. So what's wrong with it? Well, the PE ratio is 81. So some people might say that's high, and others might say, well, that just means we have very high expectations of their future growth. You pay a premium for a cutting-edge surgical robot, and therefore you got to pay a premium for the stock that makes it. So there you have it. Our deep dive into 3 growth stocks in different sectors, thriving in this AI age, and that could potentially turbocharge your portfolio. Shall we do a quick recap? Let's do it. We've explored SoFi, the fintech Swiss Army knife, offering everything from loans to crypto trading. With an impressive user growth and expanding product line, SoFi is positioning itself as that one-stop shop for the digital financial consumer while also running their competitors. Shopify, our e-commerce titan, is building the infrastructure for the future of online retail. And I love that they're dealing with businesses of all sizes. That's quite unique. And I love their innovation. And then let's, of course, not forget about Intuitive Surgical's robots, with their Da Vinci system becoming increasingly ubiquitous. Yes, I used the word ubiquitous in operating rooms worldwide. They're at the forefront of a medical revolution. Now, I can almost hear Winston thinking, but Felix, are these stocks guaranteed to make me rich? It's a fair question. And the answer, of course, is no. These stocks, like any investments, come with their own set of risks and challenges. Think of these stocks as a high-performance sports car. They have the potential for incredible speed and excitement, but they also require skilled driving and careful maintenance. And that's very much the same thing you've got to apply to your portfolio. If you want to learn more about our strategies, about how we do that, then I mentioned early on that our teaching portfolio is up over 80% this year alone. If you want to learn exactly the 3 strategies that we apply, easy to implement for beginners, then come and join our live trading training this coming week. The link is down below in the description. And I thank you for watching. I thank you for tuning in, and I wish you wonderful success investing. Take care. Imagine waking up in 2030 to find that the cloud computing market has exploded to a staggering 1.6 trillion. Well, you might want to set your alarm, because that future is